This broadcast has not been reviewed by the MAS. The views expressed are the speaker's own and not Tiger Brokers. Kenny, can you flip to the second page? And today's session is strictly for educational purposes and is not financial advice. Investing involves high risk and past performance does not guarantee future results. For those joining us for the first time, a quick introduction to Tiger Brokers. Tiger Brokers is a leading global online brokerage firm. Beyond just trading, our Tiger community provides a wealth of expert commentary on market trends, industry news, and high conviction investment opportunities to help you stay ahead of the curve. And for viewers who are interested in exploring investment opportunities further, you may also download the Tiger platform, open an account, and fund it to access a wider range of investment products. Our flagship trading app, Tiger Trade, has over 20 million users with more than 2 million active investors across many countries. It empowers you to trade a wide range of securities in the US, Asia, and Australia. And that's not all. We also have powerful tools to enhance your investing experience. We have very handy tools like Tiger AI, Boss Card, and a Cash Boost account. So with Tiger AI, you can analyze market data and generate insights in real time. And with the Cash Boost account, you can get at least 20,000 Sing dollar to enlarge your equity and ETFs buying power. So if you're ready to take the next step, check out Tiger today. And also later on, we will put in the comment section. You can open an account and deposit using Kenny Law's referral code to unlock exclusive USD cash vouchers via his Tiger Prestige account. And so now, before I introduce our special guest for today's live stream, next page, please. I would like to mention that we have prepared 3 lucky draws with 1 winner chosen each time, where you can walk away with exclusive Tiger merch. And also we have prepared Tiger coins for everyone tuning in today. So stay for 10 minutes total to grab 25 Tiger coins, or keep listening until you hit 50 minutes to get 50 Tiger coins. Enjoy the session, everyone. And to participate in the lucky draw, you just need to leave your answers in the comment section and our team will randomly pick one winner. So now, without wasting any time, we will move straight into our first lucky draw round. So our first question is, which financial asset classes have you traded? For example, stocks, ETFs, bonds, S-REITs, or trusts. Please name them in the comment section and we will randomly pick a lucky winner. Okay, we see so many people are commenting right now. All right. So this question has no specific correct answer, so a lucky winner will be selected randomly from all participants. Okay, next page, please. Okay, next page, please. Let's get into it. Today's topic is how to build a dividend portfolio to pay your bills. Our special guest speaker is Kenny Law. With over 20 years of experience, Kenny is a wealth advisory director, the founder of REITsavvy.com, and a prominent SGX Academy S-REITs trainer who works closely with the Singapore Exchange. And backed by his CFP and AEPP credentials, he specializes in building secure passive income for retirement. You have likely heard his market commentary on Money FM too. Kenny, welcome to the session.
Here, Wanning. I'm going to sleep soon. All right. Good evening, everyone. I hope you have get ready for this session. All right. So tonight topic would be how to build a dividend portfolio to pay for your bills. So this session is designed for the beginner, especially to those investors who want to know how to build a dividend portfolio comprises of different asset classes. Okay, so just have your comment on whether you feel that at the present moment, inflation is killing your paycheck, right? If you think that you are not able to keep up on the inflation, based on your current income, you just type one in the comment section. If you think that the inflation is killing you, just type one. If you think that you're still okay with the inflation, your income, you're still able to pay off all the bill, you can put zero there. So I want to understand that on the ground itself, is everyone feeling the pinch of having a high inflation, then you have a difficulty paying bills, or you are pretty okay with that, right? Just keep your comment coming, right? One, basically you are worried about the inflation, and zero means that you are okay with the inflation at the present moment. Wow. Okay, there are a lot of ones, and also some of you're okay with the current inflation. All right. So, okay, so I believe that maybe a bulk of you maybe have not started any investing before, right? You are still keeping a lot of cash on your bank account. Okay, I just want to highlight some of the so-called invisible enemy to all the bank saving currently you're having now. Whatever cash actually you are in the current bank account now, you are only enjoying the bank interest of 0.05%. All right. So over the long term, if you open up your maybe internet banking itself, you don't see your saving or your cash value drop over the long term. That is just based on the value itself. But when you convert to the real world, basically you are able to see that the ability to buy a real world goods is actually slightly bleeding up. This is something like whatever saving currently you are having now, actually you have a leakage from your purchasing power, right? Because in Singapore itself, the Singapore food inflation is at 1.8%, is pretty high. So minimally, you need to make your cash in the bank work harder for you, at least to beat the Singapore food inflation, right? Because every day we need to eat, so you need to make sure your money will not lose its purchasing power due to the food inflation. So just pay attention to this 1.8%, all right? Because that can be served as the goal whenever you look up some sort of investment out there, at least that you need to beat this 1.8%. All right. So what does this real you get means? Okay. Okay, just now, as what I mentioned, you need to beat this 1.8%, right? If you are putting your money in your bank saving, you are only enjoying 0.05%. And if you put your money in a 1 year treasury bill, currently you're only enjoying 1.45%. You still cannot beat the inflation. In terms of the purchasing power, you're still losing out, right? If you are investing in the Spider STI ETF, you get 3.16% at the present moment. You still can beat the inflation. If you invest in Singapore REIT, in general, at the present moment, average yield for the Singapore REIT is a 5.9%. So that is the real yield gap you want to target to achieve, which means that the higher the dividend can be generated from your investment portfolio, the better, because you have a lot more margin of safety to beat the inflation. So lucky draw number two, all right. Which investment vehicle provide a positive real yield after the Singapore food inflation, right? Keep your answer coming. A is bank saving, B, 1 year treasury bill, C, Spider STI ETF, D, traditional saving account. Okay, we are talking about positive real yield. All right. Okay, I'm going to close this quiz now. The answer is Spider STI ETF. If you can remember what is the current yield on the STI ETF, you can type in the answer. Hopefully, you still can remember what is the yield, dividend yield provided by Spider STI ETF now. Can you remember what dividend yield? Right, just recap what I have shared just now. Okay, the STI dividend yield is 3.16%. Okay, just take note. Okay, now I move on to what other asset classes, right, which will give you the dividend. Okay, so there are many investment instruments out there which can pay you the cash flow. Okay, so the short term basically is the correct term is a cash flow. Whatever investment you are having now, after a certain period, it can be 3 months, can be 6 months, or can be 1 year, the investment you have invested in will pay you cash back regularly. So if you are holding the stocks, they will name all the cash flow payout as the dividend. If you are investing in bond or fixed income, the name for this cash flow is coupon, right? If you invest in REIT, basically, the rental income distributed by REIT is called DPU, distribution per unit. So all of them have the same meaning, which is the cash flow, but using the different asset class, they name it differently. So whenever you see the dividend, coupon, or DPU, basically the meaning are the same. They are just your investment paying you back the cash. Okay, this is how an income portfolio actually works. All right. For example, every month you have earned your salary from an employment. You set aside certain capital, for example, 10,000, right, as your invested money. What you can do is based on this $10,000, you go out there to look for the bond, the equity, or stocks or REITs to invest. And all this investment, they will they'll pay you the dividend or distribution every quarter or semi-annually or every year. So whatever dividend or cash flow received by you, what you can do is you can either pay off your bill. The bill, it can be pay off your transportation bill, mobile phone bill, or maybe the ERP charges, parking, okay, whatever bill we can decide, all right? Or if you don't want to pay the bill out upfront, you want to keep all the dividend generated from your investment. What you can do is you can reinvest back your dividend and look for some other additional investment to invest. Okay, over a certain period, over the long term itself, your own capital you become bigger and bigger. You start to grow. Then after that, of course, after growing for a sizable amount, the dividend generated from your investment portfolio, you grow as well. So if one day, you just imagine, all right, whatever cash flow or dividend generated from an investment portfolio, more than the money expense you are spending, basically you will become financial independent. As simple as that. All right. So achieving financial independence is not difficult. You just need to have a very systematic and also disciplined investing approach to really grow your passive income portfolio. Once your passive income portfolio, the cash flow, cash inflow, more than your money expense, you will be financial independent. All right. Just take note of this simple formula. Okay, now how to translate the yield into the lifestyle? Okay, eventually, maybe at the present moment you are still at a younger age or you just started investing, you have not arrived at your retirement age, but eventually every one of us will retire one day. by the time we quit our job, we are no longer working, we need to have some sort of income from somewhere. All right. The way we to generate the income in future definitely has to come from our investment portfolio. Okay, let's see the example. If you have $10,000 invest today, let's say that you invest in one of the REIT ETF. REIT ETF can give you 5.9% dividend yield annually. All right. Every year, you will be getting $590 per year. This is pure passive cash flow. And what can you use for this $590? You can pay for 1 month of utility bill. Okay. If you increase your investment amount, for example, you have 100,000 to invest into the 5.9%, you will get $5,900 per year. And if you divide by 12 months, you're getting a few $100 per month. And that will offset some of the money expense you have to pay. Okay, over the long term, if you decided you want to grow your portfolio as much as possible, you want to delay all the spending on all the dividend, all right? So using the rule of 72, basically for example, I just quote some example. If the if you are able to invest in some instrument to give you 8% yield, your money will be double uh, after 9 years. All right. So based on this example itself, okay, using the dividend reinvestment yield at 5%, right? Your $10,000 you'll be grow to 16,200 and $88 at the year 10. Then another 10 more years, you'll be grow to 26,532. So what you need to do is you just continuously reinvest your dividend and let your dividend to compound over the long-term period. Okay, that will create a snowball effect. Okay, now, now the next thing is how to choose and where to identify the investment vehicle that matches your desired level of involvement. Okay, there are a few type of instrument out there for you to choose from, right? So on the left hand side itself, these are the instrument done for you. Exchange traded fund ETF is one of the investment instrument which is pretty to invest in and also pretty diversified. So ETF basically they will buy a basket of dividend stocks instantly with one transaction. You do not need to do any stock picking. Basically, after you invest in an ETF, you just need to wait for the dividend payout, maybe half a year or 1 year later. All right, this is a done for you solution. Right. On another hand, on the right hand side itself, if you know how to do the stock picking, you can choose the individual stock, bond, or private credit that you can invest. And you need to do a lot of homework over here doing the stock picking. Later, I will show you some example how you can do the screening of what are the stocks that you can invest in, how to check their dividend, and whether their dividend is sustainable. All right. So in between, you have a unit trust. Basically, you can invest in a unit trust. Unit trust would be managed by a professional manager. The professional manager will help you to do the stock picking, and also after investing for a certain period, they will deliver the dividend to you, right? So basically, you do not really need to do a homework for yourself. What you need to do is just choose the right fund manager and they will do the work for you. Of course, because someone is helping you to do the stock picking, you have to pay them the professional fee. All right. And the other advantage of dividend investing in Singapore, if you're overseas investor, you are not really understand the Singapore tax regime. Okay, one of the key advantage investing in Singapore dividend stock is the dividend generated from Singapore tax resident company or individual basically are tax free. In Singapore, there is no dividend tax, there's no capital gain tax, there's no estate duty. So Singapore itself is quite friendly for the investor to investing in the Singapore local stock market. Okay, so what are the key things to look up for when you are building your dividend portfolio? All right. So there are few type of characteristic in the portfolio you have to pay attention. If you want your portfolio to be defensive, all right, you can look for those utility and consumer staples, that kind of stocks, right? Because all these stocks they provide a very stable, highly defensive during the market downturn. Okay, for example, every one of us we need to pay for the water and electricity bill, whether it's during the recession or during the growth period, a poor economic situation or very good economic situation, we still all have to pay for all this kind of water consumption and also the electricity usage. So these are the defensive sector. Investor can allocate some of the your capital into it so that you are consistently getting a very reliable that kind of dividend. Okay. Now another category would be the high yield generator. Comparatively, those in the real estate sector and also REITs in general, they are generating a higher dividend compared to those utility sector. And one of the advantage of investing in REIT is they are backed by the physical real estate, right? Those are physical property. And as long as the property is still there, as long as the property continues to attract the traffic, can rent it out, basically you are the landlord of your investment because they rely on the rental income to give you the dividend. Okay. Now, and a third category will be the growth. Okay, basically, all this stock itself rely on their business. Okay, for example, a bank rely on the interest their revenue collect from their borrower, right, so that they can pay us a dividend. Okay, however, all this growth sector, for example financial or emerging market, that kind of business, they're highly sensitive to economic cycle, but they also on another hand they are able to offer higher growth rate. Okay, the dividend you grow over the long term. So in short, your dividend portfolio can comprise all these different type of dividend portfolio, right? Your job is to do the allocation accordingly, right? If you are defensive, you do not really want to have so high volatility and also want to have more predictable that kind of dividend, maybe you should allocate more to the defensive angle. If you have a very long runway, you are able to wait for the market to recover, or you don't mind the volatility of the share price, you can look for those high yield, that kind of dividend stocks. And also over the long term itself, they also can provide you and give you the growth in the DPU or dividend you receive. Okay, so one of the key thing here when you doing the selection of your stocks itself, right? Do not just purely look at the yield. Okay, it is very dangerous if you just purely look at the yield. 8% dividend yield does not mean that it's a good choice compared to the stock which give you only 5%. High yield does not mean it's the good business. Okay, so this is one of the key thing that I want to highlight. Do not do not just invest based on the headline yield. Okay, you have to look at the fundamental of the business and to see whether their business is able to generate the cash flow over the long term. Okay, so these are the key things you have to pay attention to. One of them, that the stock itself must be able to generate strong cash flow. Whatever revenue, whatever profit they are generating from a business, they can pay you the dividend. So the money they make from their business can pay the dividend to you. Example, if the company makes 100 million per year, definitely the company can pay 80 million back to the shareholder. All right, because in the profit is 100 million, they pay to the shareholder 80 million. That is called sustainable, that kind of dividend payout. And the payout ratio is 80%. All right. Then if you look at some of the company, maybe they are making 100 million, they pay out 120 million. You can see that the money they are able to generate actually less than a dividend payout. Okay, that will be the danger of whether they are able to continue to pay the dividend in a subsequent year. All right, because the payout ratio is more than what they can earn. Okay, and the other thing to take note would be the increasing trend. The dividend received, okay, you receive a dividend must be on an increasing trend. This year, maybe you receive maybe 50 cents. Next year, they give you 55 cents. Subsequent year, they give you 60 cents. The dividend has to be growing. If the dividend continue to grow, that means that the fundamental of the business, they are doing well. All right. So if you see some of the company, they start to cut dividend, okay, and the operating cash flow keeps shrinking, okay, those are the warning sign. Those are the red flag. Like operating cash flow keep dropping, they start to declare dividend cut. Okay, there will be fundamentally, that means their business may be facing some headwinds. Okay, as an investor, you need to look into the detail on why the operating cash flow is dropping and also why the company they are cutting the dividend. Okay, then maybe that is a time for you to get up and sell your stocks. Okay, the other thing that to take note will be the sector vulnerability. All right, because business cannot be continue to stay where in the very long term. All right, except some of the business, for example, utility and also electrical supply. Okay, maybe they can stay for 100 years, 200 years, because every one of us we need to consume the water and also electricity. Okay, I just quote one example to you. We used to drive the combustion engine, that kind of vehicle, okay, our car. Right now, with the invention of the electrical vehicle, okay, eventually, uh, in future, most of our car will be changed to EV. That means that whichever business they are still involved in the old combustion engine, mechanical, that kind of uh, so-called car, okay, eventually they'll be phased out, right? Those are the sector will be phased out. So if you are just buying and hold on those old technology, old sector itself, eventually the profit margin will be eroded and eventually they are not able to pay out the dividend. Okay, so the bill payer blueprint, after you identify what are the underlying stocks or company you want to invest in it, okay, what you can classify, okay, and also split your investment portfolio. What you can do is there are some of the predictable and also micro expenses. All right, what you can do is maybe temporarily you can park into the 1 year T-bill, then pay you 1.45%, and you pay for all these kind of micro expenses. Right, if you want to have a broader lifestyle cost, you need something instrument to give you a higher dividend, right? So you can use the dividend for you to go for holiday, to maybe have a nice meal, go to restaurant. Okay, this can be one of the bucket you can use and you can build, right? And the other thing is, if you want to go for some of the nice grocery, or want to have some nicer house, or maybe increase your spending itself, okay, basically you need to look for some portfolio to give you that kind of booster. All right, so very much depends on your lifestyle and how do you want to fund your lifestyle. In order to fund a lifestyle, you can build a different portfolio to fund your lifestyle. Of course, the risk profile and also the price volatility will be different, and based on the lifestyle, you can work backwards to work on your portfolio. All right, and also the dividend yield you want to achieve. Okay, lucky draw number 3. So in the bill payer blueprint, which asset class is the booster for heavy recurring liability? right? Keep your answer coming. Right. A is 1 year T-bill, B is SPIDER, STI ETF, C SG REITs, and D bank saving. Right. The booster for heavy recurring liability. Okay, I'll stop here. And the answer is SG REITs. SG REIT, you give you 5.9% dividend yield. Okay, now next. Let's say that actually some of you may be approaching the retirement age, or you are planning to build a passive income portfolio, right? So I just give you a 1 million blueprint to generate more than $5,000 a month in the passive income. This is exactly what I am doing for my client who are planning for the retirement or have already retired. Okay, so basically, I would not allocate into one asset classes. One of the very important strategy is through diversification into different asset classes, because the market will go up and down, and is pretty volatile over the long term due to the news, due to the economic situation. What you want is you want the asset class or underlying investment that do not correlated to each other, right? When the market crash or when the whole economy go to recession, we don't want our portfolio all go down together. All right. So normally, what I would do based on this 1 million blueprint itself, 30% allocation to Singapore REIT. Okay, but do take note, Singapore REIT is very interest rate sensitive. Under the high interest rate environment, Singapore REIT will be affected. When we enter into the low interest rate environment, Singapore REIT, you tend to do well. All right. So Singapore REIT, in this case, you give you a 5.9% dividend yield. And you also can allocate 20% into dividend stocks. Okay, individual stock like DBS, UOB, YCOM, and so on and so forth. In Singapore, easily we can get between 4 to 5% for those dividend stock itself. All right. So another asset class, in order to stabilize or reduce your portfolio volatility, you can allocate 20% into the fixed income. Fixed income, it can be comprises of short duration bond or some of the emerging market debt or government bond itself. In terms of average yield is also between 4 to 5%. Okay. And another asset class, you can invest in a multi-asset. All right. Beside the traditional equity and also fixed income, there are some of the alternative investment in this multi-asset, and also there are some one strategy, for example, option writing. Okay, in this kind of multi-asset income, because multi-asset income under the uncertainty during market uncertainty, the portfolio volatility tends to be much more lower than a dividend stocks. Okay, and if you are accredited investor, you can look for another asset class as alternate investment, right? Such as the private credit and some of the option writing strategy. Okay, because all these alternate investment, they are totally not correlated to the stock market. Okay, they are doing their own thing, and that will give you very consistent that kind of dividend and also very high risk adjusted return Sharpe ratio. Okay, so all in all, getting the this portfolio will give you around 6%, and you divide by 12 months, the money cash flow is easily can be $5,000. All right. So diversifying across these five distinct asset class create a low volatility engine, right? The reason of diversification is to reduce the portfolio volatility. Okay, and you can use this strategy to pay for your bill over the long term during your retirement years. Okay, so I will later show you how to and where to get the resources to start to help you to get started, right? So before I show you the example, I'll show you the resources. Okay, I just want to summarize what you should do as an investor if you have not done something, have not done anything yet. Okay, first thing that you need to recognize a saving trap. Okay, parking your money in the bank and enjoy the 0.05% uh, is really not workable under the current high inflation environment because your purchasing power will be eroded. Doing nothing, okay, doing nothing, definitely you lose your money. All right. That is the first message I want to send. And second thing would be in order to get yourself to build a dividend portfolio, you also of course need to open a brokerage account. Lah. I assume that most of you have already have an account with a Tiger Broker. If you don't have, I have my link over there. You can use my link to open the account. All right. So one of the advantage and one of the offer I offer to those investors who open the account with me and also fund $200,000 saying I will offer a 2-hour complimentary one-on-one private tuition and go through with you how to build and how to do the stock selection or some of the investment selection to build up your retirement portfolio or passive income portfolio. Okay, so there will be the personal one-on-one coaching session. All right. Then the third step would be you can select your income tools. Okay, there are many solutions for you to select. All right, just choose the asset class that you are comfortable. Each of them have pro and cons. Okay, so during the private tuition session, all right, I will explain to you the pro and cons of each of the asset class. Okay, more importantly, whatever investment you choose must be suitable to your own risk profile and also objective. Okay, and you are not going to build a retirement portfolio within 1 year or 2 years. All right, for me, I spent close to 15 years, 15 years to build my retirement portfolio, right? A sizable retirement portfolio. So that I can comfortably retire at the age I want, right? So start building today. Okay, if you have any question, just post your question on the comment section. Later, Wan Ling will help to ask me those questions at the Q&A session. Okay, now I move on to show you where to get all those resources to get you started. Okay, so first thing first, if you want to have know what to invest for the under the Singapore Exchange, all right? Okay, you can come to SGS Group. I show you where you can get all the stock code. Under sgx.com, okay, come to stock exchange. Okay, and anyway, this session is recorded, all right? So if you're not able to follow me, you can just go and review the recorded video on the YouTube. Okay, under stock exchange, you come to stock screener. All the stock listed on SGS is shown here, right? There are many of them. For you just choose. For example, HS, Optimus, Asia, Medic, so on and so forth. All right. You have all the share price here, and also they'll show you the dividend yield here. All right. So you can see that. You can see that Lion Asia Air Asia Pack, they give you a 45% dividend. Okay, just now I mentioned already. Do not invest, just purely look at the dividend yield itself. Okay, there are some risks. You have to understand the underlying why this stocks is giving you such a high dividend. Okay, there are maybe some risks here and there. Okay, another example would be Asian Pay TV Trust. They'll give you 12% dividend, okay, and so on and so on. There are many dividend stocks for you to choose from, all right? So this is a one area if you want to do the individual stock pick, okay, you can come to the SGX stock selector, okay? Now, if you want to use an ETF, okay, ETF is when investing in a basket of the stocks, and that will reduce the portfolio volatility and also reduce the risk. You can also come to the sgx.com under the ETF screener. Okay, there are a number of ETF over here, right? You can see that the Spider STI ETF, Go ETF here, Amoa STI ETF, Lion Philip S Street ETF, Lion Gold Lion OCBC tech sector. This one is investing in a tech sector listed in Hong Kong. But this some of them they are not paying dividend. All right, you have to read in detail. Okay, so SGX is one of the resource page. You can find all the investment or stock code that you can choose from. Okay, now another website. This one is a read from Read Savvy. Basically, Read Savvy has compiled all the 39 reads over here. Then you can look at all the yield here, right? For example, first read at the present moment in the REIT space give you 9.2% dividend yield. Cecil REIT 9.2%, ESR REIT 9.1%, Elite UK REIT 9%, okay, and land lease global commercial REIT. Okay, if you visited Orchard before, Somerset 313, the mall there actually owned by the land lease global commercial REIT of 6.6%. If you have visited Vivo City owned by Mapletree Pan Asia Commercial Trust, okay, 6.2%. Now OUE Downtown 6.3%, right? OUE Downtown owned by OUE REIT, okay, and CDL Hospital Trust, the Orchard Hotel owned by CDL Hospital Trust, 6.2%. And if you work in some of the industrial park or business park in Singapore, probably you know Ascenders. CapitaLand Ascenders risk is giving us about 6.1%. Okay, Parkway Life REIT, Parkway Life own Gleneagles Hospital and also the Mount E Hospital. Even the hospital REIT or healthcare REIT, they are giving us 4.8%. All right. If you want to invest in a data center, let me see data center. Okay, Digital Core REIT, they own the data center 7.1%. Okay, and if you want to look at a student accommodation or worker accommodation, Centurion accommodation rate, they're just IPO. They pay up the first quarter of 1.6%, but if you multiply by four, the annual dividend rate will be around 6 point something percent. Okay, Keppel Data Center is another one. Keppel DC rate 4.5%. So there are many dividend stocks and for you to choose from. All right. So these are just a headline yield. So just now I've keep mentioning that do not purely look at a headline yield. You need to look at the track record. Okay. Now I use First Street as an example. First rate, although giving us 9.2%. Okay, so what are the risks? Is this 9% yield is a good rate to buy? Okay, then you have to go into the detail on their previous dividend track record and to see that whether the dividend is continue growing or there are some other issue. All right. When you click on the first rate, there are a lot of financial ratio. I'm not going to cover today. All right. I will cover in other live stream seminar or webinar. Okay. But I just want to show you the dividend track record. All right. This was the dividend. Okay. In red, we call it distribution per unit. You can see that first rate they used to pay the dividend every quarter. They used to pay close to 2.15 cent per quarter. All right. And now, because of some problem on the underlying property itself, all right, they cut the dividend. Now the dividend dropped to 0.5 cent per share. Okay, there's a huge drop in terms of dividend, right? Although it give you 9% headline yield, but dividend has dropped a lot. And because of the drop in dividend, that's why you can see the share price also drop from a top and currently at the bottom. Okay, so this is one example. Now I show you another example. Okay, Keppel DC. You see, Keppel DC, the dividend yield is only 4.5%. Not attractive, right? Compared to first rate, compared to ESR, not attractive at all. But we need to look at to see that whether their dividend is growing. Okay, Keppel DC, if you compare to the previous dividend history since IPO in 2015, you can see that dividend grow from 1.62 cent per share today 2.833 cent. And recently, for the past few quarters, actually they are on increasing trend. Okay, so although Keppel DC rate is giving us 4.5%. If the dividend yield or dividend payout continue goes up, actually your yield on cost, because if you invest today, you base on today's price, yield on cost, you grow year over year. Okay, so this is a shortcut way. Okay, I'm not saying this is the best way. It's a shortcut way for you to identify which REIT to invest. Okay, just purely look at the past DPO payout. Okay, now I'll move into the next resources. All right, if you are the Tiger, uh, you have already have a Tiger broker account, you can access into this so-called the platform. All right. So I use this platform to do my analysis. Okay, it's pretty easy to use MBC to have a visual check. Right. I do not need to go through all the number itself. Okay, I'm just using DBS as an example. Right. So DBS, okay, where to find the information straight away? The first thing, quick check is more on a dividend. And click on dividend, you can see this chart accordingly. Okay. Just now I have mentioned, in order for the stock to pay dividend, they need to make sure they make money first. The revenue or profit generated from a business must be more than the dividend that can pay out. All right. So let's look at the DBS. Let's analyze. Okay. So in this orange color is a net profit. You can see that actually DBS, the net profit is growing year over year. Okay. They are making this money, right? Generating this cash, and they are paying out dividend. Okay, this purple color dividend, they are paying out this dividend. Okay, so based on this trend, okay, they are making more money than they can pay a dividend. All right. So over the long term, as long as they make money and make more money, they are able to increase their dividend payout. Okay, this is a good news. Okay. So this is one of the key fast check. You can check whether the dividend is sustainable or not. All right. Then you compare to the previous dividend payout to see the dividend whether it's going up or coming down. Okay, you can see that from the DBS here, the dividend payout is increasing 0.75 cent until 0.81 cent now. All right. Okay, just look at the past history, then you can see that whether their dividend is growing or not growing. That's the reason why DBS share price continue to break new high, and you can see that actually they have been increasing a dividend since 2017. 2017, they only pay 0.3, right, cent per share. Now they are paying 0.81, right? 0.81 per share. How many times they have increased already? Okay, now another example. Okay, OCBC dividend. Okay, first thing to check, net profit. They are making more money from their operation, from the business, and so that they can pay the dividend. It's more than that. Okay, UOB, same thing, right? They are making more money to pay the dividend, all right? But just take note here that actually recently for the past a few quarter, actually the profit making is dropping. Okay, this is one of the concern, but it's not really a major concern. In general, they are still doing pretty well. Now look at another stocks. Okay, by the way, it's not recommendation now. Whatever thing here, I just show as an example only. Now, Sheng Siong, okay, quick check. Net profit is more than the dividend payout, all right? And as long as they can continue to grow their profit, they are able to continue to pay a dividend. Okay, now let's look at, okay, HPH Trust. Okay, this is a business trust. You can see that actually it's not so, it's quite ugly, right? You look at the past dividend payout. Okay, from here you can see that last time they used to pay 0.029, then after that increase for a certain period, then after that they start to cut a dividend. All right, you can see that actually they are also at one time losing money, and the net profit is only this much, right? Not a lot, and the dividend, they are still able to pay dividend, but the profit is not really growing. Okay, now I want to okay, Starhawk. Let's look at Starhawk. Okay, first thing first, net profit. Net profit is coming down. net profit is coming down. Okay. And the dividend, that's why you can see net profit coming down, dividend also coming down. That's why they have a dividend cut, because their operation is not able to generate positive cash flow enough, or growth in a positive cash flow enough. If the net profit is not growing, the dividend you cut eventually. Okay. Ycom. Ycom, you can see that the net profit is pretty stable, and recently has a pickup on the net profit itself, right? If they continue to pick up and also grow in their profit margin, right? The dividend in future they may increase. Okay, so these are some of the example how you can do a quick check just looking at this chart itself, right? But if you are the number people, okay, what you can do is you can go to the financial statement. Okay, a quick one again. Look at the cash flow. Look at the cash flow. Okay, so what you can do is you look at the annual cash flow and also quarterly cash flow. Okay, do a quick one. Check the cash from operation. Okay, you do not want the REIT or the stock go and borrow money to pay your dividend, right? You want them to pay the dividend from their normal operation, because this is more sustainable. And you can see from here that annually they are generating positive cash flow, right? If they generate positive cash flow, they can pay dividend. If they generate negative cash flow or drop in the cash flow, that would be the warning sign. If they continue to pay dividend, because they may not have enough cash for them to sustain the operation. Okay, and you can see from here to see whether it's increasing or decreasing. All right, the balance sheet or income. Okay, income statement here will show you whether revenue is growing. Right, if revenue is growing, the net profit is growing, the cash flow is growing, so the dividend is sustainable. Now we look at SIA. Okay, first thing first, is SIA is a good dividend stock based on the trend? The answer is no. You can see that SIA also losing money, right? Now they are all those they have making some of a profit, but the profit is also dropping. When the profit dropping, the dividend will start to drop. All right. Whether it's sustainable or not sustainable, we need to see that whether they can continue to make money and can continue to turn the tide or not. Okay. And financial, check the financial, look at the revenue growing but stagnant. Okay, more importantly is the cash flow. All right. So the cash flow, look at the cash from operation. Okay, you can compare annual to annual or quarter to quarter to see the cash flow whether growing or stagnant or declining. Okay, so these are the key thing for you to check, to do a quick check on the dividend sustainability. Okay, now I move on to show you the bond. Okay, the bond ETF. Okay, I've shown you REIT, I've shown you the individual stock. Now I'll show you the ETF. So this is the bond ETF. Okay, give me a minute. Okay. So bond ETF basically that comprises that buy a basket of all the different stocks. So under this bond ETF itself, they are holding HSBC holding 5.3% coupon, Temasek Financial 2.8%, Temasek Financial and another financial 4.2%, Singtel Group Treasury 3.3%. So you can see that when you invest in ETF, basically you are getting the dividend from all this underlying. Okay, it's pretty diversified. Okay, when it's very, very diversified, the risk is much more lower, right? Is if you cannot take the kind of volatility and also take the kind of risk, then you just focus on the ETF. Okay, so these are the constituent of the this ETF itself. Okay, profile and how much dividend they pay out. Okay, these are the dividend they pay out, right? For the past few years, uh, at the present moment is about 3.29%. Okay, the share price will go up and down. So the coupon more or less fixed. That's why the coupon divided by share price is the yield you are getting. So it's still pretty decent. Definitely can beat your food inflation. Remember, the food inflation is about 1.8%, right? So do something, right? Do something. And this is one of the a bond ETF. Okay, if you want to look for something higher return, just I mentioned, some of the REIT ETF, actually the return is higher. Okay, then let's look at CSOP IHS REIT ETF. Okay, what are the REITs this ETF are holding? You can see they are basically holding 24 REITs over here. Okay, it's all REIT listed on Singapore. And what are the dividend they are paying? At the present moment, the dividend payout based on the last financial year of 2025, 5.63%. Also quite decent, right? And in 2023, 2024, they are paying more than 6%. Okay, this is one of the REIT. And if you want to invest in the STI ETF, let's look at STI ETF. Okay, this is a STI ETF. They own 30 stocks, 30 blue chip under the STI ETF. All right, these are all the stock name and what are the dividend they are paying. Okay, STI ETF last financial year pay us 3.84%, and 2024, 2023, 4 point something percent. All right, so it's pretty diversified. Okay, so I hope that this is useful. And if you have a Tiger Broker account, then you can take a look, you can play around with it. Okay. All right. I come back to the presentation again. Okay. Now I hand over to Wan Ning, right, for the Q&A.
Okay, so now we'll open the floor to audience questions. So feel free to submit your queries in the comment section, and we will, with Kenny Law, we will address them live. Okay, so before that, I would like to ask a question for Kenny. So as a beginner myself, I would like to know, like, how do we know how many times a year a company distributes its dividends?
Okay.
Yeah.
So okay, the easiest one is go to visit the company website, because every stock listed on Singapore Exchange, they have to need to have the set up a company website. Under there is one section called investor relation, right? You can see the DPO, so-called a dividend payout. They have to announce it. When are they going to pay dividend? Normally, they either pay out quarterly or semi-annually. Okay, that's one source, the most accurate source of information. Go to company website to check. Or another way, you can go to the broker, different broker. They will show the dividend record. Okay, I'll show you the example. I'll show the example here. Easier to explain. Okay, let's use an example of maybe AIMS APAC. AIMS APAC dividend. You can see from here that in 2025, okay, just look at 2025. 2025, they will announce the X date. Okay, when you see this X date, which means that it's an X dividend date, right? What does it mean? If you are invested, for example, on November 13th, right? If you buy the stock before November 13th, you will you'll be entitled on the dividend payout. That means that the stock price include the dividend. If you buy the stocks after this date, the stock you own, you'll be excluded from dividend payout. Okay, that's one thing. I think one thing I believe this is something new to you. All right. So this is one of the key things have to pay the attention for the investor. If you want to buy the stock for the dividend, you have to check the XD date. Okay. Now, how frequent they pay out the dividend, you can look at the past track record. In 2025, they pay out 4 times. Okay, they pay out on February 7, May 16, August 8, November 13. That means that this pay the dividend every quarter. Okay, the XD does not mean that you will receive your dividend money. You will not receive your money during the XD. Okay, you will only receive a dividend 1 month or 1.5 months later. So this is the actual cash payout, December 24th. You will only receive on December 24th and September 24th. You can see it normally about 1.5 months or 2 months later. All right. Different stock has different dividend date and different timing. And these are all the dividend per share declared and also pay up during the quarter. Okay, so this is one example. I'll show you another example, which okay, for example, DBS. Again, come to dividend here. So DBS also pay every quarter. You can see 2025, they pay 4 times. Okay, XD date and also the dividend date. You can see that DBS actually after the XD date, they pay up 10 days later. November 13 is the XD, then November 24th is the payout date. So the investor do not need to wait for 2 months or 1.5 months before they can receive. Okay, they just need to wait for one or 2 weeks later they can receive a dividend already. Okay, Huanin, back to you.
Thank you, Kenny. It was very insightful. I learned a lot from you. And then, so now we'll go through some of the comments from the viewers. And here we have the first question, which is the from Everyday Investor. Bank, she asked, he or she asked, bank interest is so low and food prices keep rising. How do you calculate whether you're actually gaining or losing? Which inflation figure should we look at?
Wow. Uh, the food inflation, if I'm not mistaken, actually they publish every month. Okay, I'll show you the website I use. Okay, basically trading economics, Singapore food inflation. You can check all the inflation data here, right? Then you just do a comparison because every month you can table it yourself. It's pretty scary. You can see that start from 2026. 2026 in January, the food inflation is only 1.2%. Then continue to increase, okay, until now 1.8%. And I strongly believe that this food inflation you continue to goes up due to the reason of the higher oil price because eventually the oil price impact you pass on the transportation, you pass on the supply chain. So it will not come down. So what you can do is is a quick calculation, quick estimation. Whatever bank interest you are having now, and immediately you can do a comparison to the inflation, right? Okay, so then you more or less you know that whether you're losing your purchasing power or not. I hope I answer your question. It's a quick and dirty way to do the estimation. Okay, this is how I do it.
Yeah, first time learning it. Very interesting. And then the second question we have is anything with monthly dividends, yearly for rule of 72 is too slow.
Okay, monthly dividend, if you invest in the individual stock itself, we do not have any money dividend as long as you invest in the stock market or ETF. No, we do not have. But if you invest in the unit trust, some of the unit trusts they pay out monthly dividend. Okay, so you need to do the research of a unit trust. Some of unit trusts pay every quarter. Some of unit trusts again also they pay semi-annually. Some of unit trusts they purposely structure in such a way that they pay out dividend every month. That is very suitable for the investor who are planning for retirement or already in the retirement age.
以后开不到. Right. And then also we have the third question for defensive, high yield, and growth buckets. What allocation would you suggest for someone at 30, 50, and near retirement. Can you give a rough percentage guide?
Okay. So if you are near the retirement, basically you want, because you are 100% rely on your dividend portfolio. So you want your dividend more or less is stable in nature. Okay, okay, I'll show you this for better illustration. Some of the dividend yield is pretty stable. Okay, you don't see a lot of fluctuation. For example, okay, I use cable DC rate. Okay, you can see that it's pretty stable. It's pretty stable, the dividend, so that you can more or less quite be sure that you'll be getting this cash flow coming in to pay for all expenses. And some of the REIT and some of the other asset class, the dividend payout is really yo-yo, okay, and also seasonal, uh is quite cyclical, all right? For example, those hospitality sector. That's the reason you have to do a comparison and look at the past data, how the dividend payout. Can you see that? This one belongs to the hospitality sector. You can see that one quarter up, then the next quarter down, one quarter up, the next quarter down is very cyclical, okay? And there is a seasonality of the dividend itself, right? Now, when you come to seasonality, definitely is not really good for those planning for retirement because you need more consistent platform, right? If you are into that category, you don't want the yo-yo, that kind of payout, then you go for more defensive that kind of sector, right? So the allocation wise is really depends on individual risk profile and individual preference. There's no right or wrong because when you are at age 30, but you are really 100% rely on the dividend payout to pay for your expense, you don't want this kind of seasonality, right? You want to be a more predictable that kind of cash flow so that you can manage your own bill, right? Especially you need to rely on the cash flow to pay for the bill.
Thank you, Kenny. And then another question from Molia. She asked, "What are the best Singapore REITs?"
Sorry, no recommendation on the public side. Okay, but I can get you some. I just can give you some guidance, lah. Right? No specific name to mention. It really depends on your preference whether you are 100% rely on dividend. Okay, if you 100% rely on dividend, you can choose those REIT uh, which give you very stable that kind of payout, like what I explained just now. At the same time, you also have to look at the share price, okay? Because REIT being the equity class, and it can be quite the fluctuation of share price can be quite wild, right? So REIT may not necessarily suitable to you if you are risk averse. You cannot take on the volatility. Maybe you should take a look into the fixed income. Okay, so it may not be the right asset classes, right? So and the other thing is make sure you build a very diversified REIT portfolio, because REIT portfolio also have different sector here. And diversified REIT means that they have a retail mall, they have a commercial office, or logistic e-commerce under the portfolio itself. And if you do not like that kind of volatility, then you can look for those diversified REIT. Okay, because volatility you be tends to be much lower than those sector oriented. For example, hospitality sector. If you have too heavy allocation in the hospitality sector, if another COVID come, all your REIT portfolio you'll be impacted, right? And if you want to have more stable and more defensive that kind of payout, you can look for the healthcare REIT, because healthcare being the hospital itself, be it good time, be it bad time, you still need that kind of healthcare services and also hospital, right? So again, it depends on your risk profile, individual preference. Then after that, you look for the right asset class. Okay. Marlene, you there?
Oh, and all right. And final question here. We have another user asking, please explain more on T-bills. Why buy T-bills and what are the advantages and disadvantages of T-bills over other asset classes?
Okay. T-bills, okay, personally, I don't invest in T-bill, right? Uh, the reason being is, okay, T-bill is more on a short term, my view, is more on a short term parking, and T-bill, basically, there were two duration. One is a 6 month, the other is 1 year, and it's just temporary parking only, right? So and you have to roll over. Okay, it's not something like after you invest, you will consistently you get a dividend. T-bill, after you invest into it, 6 months later, you need to redeem, all right, automatic redeem, and at the same time, 6 months later, if the interest rate coming down, if you want to reinvest back to the T-bill again, you'll be reinvest at a lower interest rate, right? But on the other hand, that if the T-bill rate continue goes up, of course you renew at a higher interest rate lah. Okay, I will also show you the T-bill, Singapore T-bill, right? The trend now. Okay, so over the long term, okay, only recently, because of the fear inflation, T-bill suddenly have some rebound lah. But over the long term, the T-bill is on the downtrend trajectory. You can see that. Okay, so under the low interest environment, actually T-bill also follow the interest rate, right? In 2020 to 2022, the T-bill is pretty low, right? Only 0.3%, right? At a peak, actually more than 4%. And now the T-bill is stabilizing around 1.4%. Okay. That is not say advantage or disadvantage, because everything got uh, pro and cons. With this T-bill low rate, that means that your mortgage loan will be also lower, right? Your residential loan and what are the loan that you also lower. But on the other hand, if you have idle cash, you do not know what to do, you want something very, very safe, because T-bill is backed by Singapore government. Instead of putting a 0.05% in the bank, you can put in the T-bill lah. But the disadvantage, you lock in for 12 months, right? But of course, you can sell in the open market, but it really depends on who will be the buyer willing to buy from you. Okay, so pro and cons, right? Pro, in short, the pro is higher than bank interest rate. The con one, uh, uh, you need to wait for 12 months, right, before you can get interest, or you can sell in the open market, right? But the price may not be good.
All right, very insightful. And I think that's all for the Q&A session. And very thank you, a huge thanks to Kenny for this incredible session. I'm sure everyone walked away with some fantastic and actionable insights. And for those of you who have asked about the using how to use the Tiger Laptop app, you may go to the Tiger Brokers YouTube channel to search for the tutorials. And here, as we wrap up today's session, for those of you who would like to continue learning from Kenny Law, you can always follow his Kenny Law account and read savvy at tothemoon.com and follow his YouTube channel, Kenny Law Financial Wisdom. You can also visit his website, readsavvy.com, where he provides deeper analysis and resources on REITs investing. And thank you everyone for joining us today. We hope you found the session insightful. If you want a recap of today's live stream, you can always search for the recap video in the Tiger Trade app. We look forward to seeing you in the next one. Take care and happy investing.
Thank you. Good night.
Okay.